Hi, folks. Class is in session. My name is Jim Noble, and welcome to step 4 of the retirement countdown, the 5 steps that you should take to secure your vacation for life. And today's topic is housing and aging in place. Let's get started. So, your home, your choice. One of the most important elements of your retirement is where you decide to live, the costs associated with living there, and the setting that you live in. So these are all important considerations to make. And as you prepare for your retirement, you can look at these choices as well. Now, the ideal retirement, does it exist? Well, the first object is to pay off your mortgage. So pay off your home before retiring is essential to managing your expenses through retirement. And choosing a home that you can modify in the future will help you remain in home as we get older. And of course, being in a low tax environment is always going to be helpful. Now, a while ago, and I want to say in early 2021, I did a little research on homes in the area around our office here in North Jersey. And I found this home for $599,000. The point being, what are the challenges that we face retiring in New Jersey compared to other tax locales? So let's take a look at a comparable property with similar square footage in a nice neighborhood in South Carolina. This house is half the price. But the thing I want to point out is that in the last year, these prices have gone up dramatically. And in fact, today, when I was looking in to compare houses again, I couldn't find a house like this one for under $800,000 in North Jersey. Now, it just may be that there aren't that many houses available, but that's what it costs to buy a modest home in North Jersey. Now, why is it significant? Well, we love to see the value of our home go up in retirement because we have more net worth. But let's take a look at the taxes on these two homes. In New Jersey, that $600,000 home, which again you can't find for under $800,000, had real estate taxes of $14,000 a year, over $1,000 a month. The South Carolina property had real estate taxes of $1,200 a year, or $100 a month. So let me ask you this. Are real estate taxes in New Jersey going to go up during retirement? Well, they likely will. We do have a homestead exemption, but that's been very tenuous in our state with the state budget. So, how much investment capital does it take to cover these additional costs? Because if we're not working, we got to pay these taxes somehow. And even if we freeze our taxes in place at these levels, this is the differential. So, if we're going to invest our money for retirement and expect to take distributions for our whole lifetime, the 4% rule, which we addressed in the last subject, investments and retirement accounts, the 4% rule applies, meaning that we shouldn't take more than 4% of that principal balance each year, or we risk running out of money. The real estate taxes of $14,000 or $1,200 a month, which at the 4% rule represents $320,000 worth of your investment capital that can't be used for anything else than paying for your real estate taxes. So think about that for a minute. How much money do you have saved? How much of your capital is going to be allocated just to the cost of your real estate taxes? And if those costs go up during retirement and your principal balance is being distributed, there's a good chance you could run out of money if you've funded your tax bill this way. So the impact is that is that much less money that you have to spend in other places. Now, what are the other types of stealth expenses that you can run into? Well, I've helped a lot of people retire outside of New Jersey. And a couple of the things that catch people off guard are flood zones and hurricane insurance. In fact, I recently had a client who has had a home in Florida, several homes in Florida for many years, and a tornado came through and took the roof off of one of his houses. He didn't realize that he didn't have wind insurance. So that's another element to consider if you're in another area other than New Jersey. Then we've got the pernicious costs of homeowners association fees for condos and co-ops that are ticking time bombs of rising costs. Remote locations, if we live far out from resources or facilities, higher healthcare costs are a result. And of course, the cost of maintaining multiple properties if we have the snowbird mentality of being in both places. Now, your home, your lifestyle. During your working years, it's important to be close to home. Have a home that's big enough for your growing family and be near a quality school district. But in retirement, you really want to be close to your preferred lifestyle. If you want to be near a beach or the golf course, then you need to live near one. It has to be big enough for two, plus room for visitors, and close to quality healthcare facilities, but able to modify for aging in place. Now, your lifestyle after age 80 is likely to slow down a little bit. It does for most of us, if not all of us. Studies show that spending rates peak in our early years at 92% of pre retirement salary at age 65. The spending rate at age 80 is generally about 70% of your pre-retirement salary. And fewer capital expense items, less travel, and typically in our 80s, we're providing less family support to our children who are hopefully now responsible adults and paying their own way. And then, of course, spending on healthcare does increase. If one or both spouses needs care, the home and assisted living are wiped out. Home assets are wiped out due to the costs of home care and assisted living. If one or both spouses need care, the home and the assets can be wiped out due to the cost of home care or assisted living, which are not covered by conventional insurance, which we learned in the first section, your health comes first. Now, housing and long-term care are connected because essentially long-term care is a residential solution to our residential needs. If we need help with our basic activities of daily living, like bathing, dressing, getting in and out of bed, those things are not medical care, so they're not covered by insurance. They're more closely connected to your lifestyle in your home. Now, a well-designed retirement home will allow for one level of living, easy access, and equipped for aging and functional disability. So it's important not to have 3 flights of stairs to deal with, as well as having a bathroom that eventually you could access if you had a walker or, God forbid, a wheelchair. Because aging in place is about accommodating your needs when your needs change. Now, long-term care is something most people haven't prepared for. They haven't been able to fund a separate account to cover roughly the $500,000 of costs that are needed to fund an average 2 to 3 years of care at home in assisted living or nursing home care. Now, less than 5% of retirees have actual long-term care insurance, and many have life insurance policies that may be adapted to fund future long-term care needs, but fail to do so. Traditional long-term care insurance requires that you purchase a policy when you're young and healthy. You pay in for many years and hope you never need it. And then you hope that your premiums remain affordable because long-term care insurance premiums are not guaranteed. They can go up. And we've seen that in the last 10 years, particularly the last 5 years, where we've seen premium increases of 50, 60% that are accepted by the states that are issuing these increases for the insurance companies. Many people cancel their policies as a result just before they need them or because of cognitive dissonance. I've heard lots of stories of clients who got a bill and then just didn't pay it. And that might have been a result of a cognitive dissonance, a long-term functional disability. Now, the long-term care insurance pays a specific a dollar amount for a specified length of time based on the coverage you purchased when you took it out. And it may not fully cover the costs when you need it. It depends on what you design. Now, there is this option now of a life and long-term care hybrid insurance that allows you to apply for coverage at any time Even in your 70s, the policy has a rider that allows you to access cash benefits payable as the death benefit for chronic illness or long-term care services. And it may pay monthly or as a lump sum. The benefits typically are paid to you and you decide how to spend the money. And you get care in the place that's best for you and your family. An existing policy may be a source of funding for this, or cash or CDs earning very low interest. Now, who would you rather have pay for your long term care? Your savings or your home equity or the insurance company? There's a big incentive not to come up with the cash to pay for these expenses when we're paying for it with our own assets. But when we're looking for the insurance company's dime, we learn how to fill out the paperwork and get paid. And as a result, we have access to the care and services that we need. Now, it's much better to use other people's money whenever possible. And it's important to give your adult children the tools that they need to help you with their care. Now, what are the costs of long-term care? Well, home care can be $2,000 a month to $14,000 a month for round-the-clock services. And we've all heard about these dramatic expenses. Unfortunately, until we've exhausted our personal resources, either as a married couple or an individual, we're not going to get any help from the government. That's Medicaid, and Medicaid is for the poor and the indigent who have exhausted their assets to pay for their care. The topic of aging in place, retiring out of state, and long term care may be of interest to you. So please reach out to our office and we'll be happy to answer your questions. My name is Jim Noble. I'm a certified financial planner, and this has been step 4 of the retirement countdown. Thank you.